This week on Wealth Track, putting your retirement portfolio on autopilot. Financial thought leader Burton Malkiel has teamed up with online investment advisory pioneer Mitch Tuckman to offer retirement portfolios of low-cost index funds that automatically rebalance. Why they believe the combination will lead to smooth retirement landings is next on Consuelo Mack Wealth Track.
So Rebalance IRA is an investment management firm, and we focus on everyday investors who have between $100,000 and $1 million. Generally, they're over 45, and we manage their retirement assets for them. And we help them. Our mission is to help people retire with more. They're not do-it-yourself investors, and we manage their money in a very low-cost way under a fiduciary standard, and we offer them a credentialed, highly trained advisor and a support person as their team to work with. And we execute an investment methodology that I'm sure we'll talk a lot about because this man sitting next to me is responsible for having invented quite a bit of it.
Right. So Burton Malkiel, here you are. You're an investment icon. And I'm sure that you get approached, many times a day, a week, whatever, to, get your name on a committee and to get involved in a company, because anyone would love to have your reputation behind them. So why did you get involved in Rebalance IRA?
Well, because I wanted to put my name behind something I really believed in. And I think, as Mitch just said, that most people just get terrible investment advice. They get it from people who are conflicted, who are not necessarily interested in the investor's best interest, but are interested in their own, and therefore they're very high-priced, and they put investors into the kind of funds where they get an extra commission. So the funds themselves are very high-priced. And so I would only put my name behind something that I absolutely believe in. We use nothing but index funds, low-cost index funds at Rebalance IRA. I've believed in indexing from before the time that index funds even existed.
Right. How many portfolios are you offering? How do you make the decisions? I know, Bert, that's part of your job, is to make the decisions of what goes into the portfolios. But Mitch, do you want to tell me about kind of what the model is?
Sure. Well, there's basically six model portfolios. They're bookended by an income portfolio and a growth portfolio, and then the four in the middle. And basically what we've done is we have created a growth portfolio of index funds that includes U.S., foreign developed, emerging market. We believe in a small cap tilt, as they say in the business, and some REITs.
You've got stocks, you've got bonds, you've got dividends, whatever.
And then on the income side, we have, now this is where Bert and Charlie Ellis, who's also on our investment committee, have actually said, certain markets are not efficient.
I'm an index investor. I believe in indexing. I would start off saying buy a total bond market fund. Right. But if you look at what's in a total bond market fund, it's about 2/3 either direct treasury securities or government agency securities.
Right, this is the Barclays aggregate, right.
Which are in effect government securities.
Yes.
And the yield is, in my judgment, quite inadequate. And so what we have done is we've tried to look at parts of the bond market that are not too risky, but give the investor at least some chance of a decent return. And we've also used an income, a dividend-paying stock substitution for at least a part of the bond portfolio. So there are some interesting things that we've done. We generally have a little more of a portfolio composition in foreign and emerging markets than other investors, because we start off from the view that a lot of these markets are basically cheaper than the U.S. market. I think it is less well understood than it should be what kind of advantages you get from rebalancing. Let me give you a little simulation that I did with simply two investments, a bond market index fund and a stock fund. Starting in 1996, just when Alan Greenspan made his famous irrational exuberance speech. So what we do in this simulation is once a year. We did it at the beginning of January. You could do it anytime. You simply said, let's say you have a 60-40 portfolio. 60% stocks, 40% bonds. And every year, what rebalancing means is you just bring the proportions back down. And that rebalancing once a year added between 1 and 1.5 percentage points to the return. Now you may say a year, per year.
Yeah. What's a realistic expectation now for a diversified portfolio as far as annualized returns? Bert, it's come down a lot, right?
My sense is that a diversified portfolio of common stocks, one ought to think of certainly no more than a 6% rate of return. I don't think it will be the 9 to 10% that we've enjoyed over the last 100 years. I think that by getting into some of these other markets, like emerging markets, we can do a little better than that. I think real estate is still a relatively good investment outlet for people, which we access through REIT index funds. So I think we might be able to do a bit better than that, but we are clearly in a single-digit world today, and we don't want to give anybody the impression that it's 10% from now till kingdom come. It just isn't. And what's important for people to realize is if they are saving on the basis of thinking that they're going to get 10% rates of return, I don't think it's going to happen.